Please like, share, and subscribe. Wishing you happiness and good luck every day.
So what if I told you that you could become a debt-free millionaire on a teacher's salary? Sounds kind of crazy, right? Well, according to Andrew Hallam, it's totally possible. And in this explainer, we're going to break down his incredible book, Millionaire Teacher, and uncover the simple rules of wealth they really should have taught us all in school. Okay, but before we dive in, let's start with a really important question. I mean, this one gets to the absolute heart of everything we're about to talk about. What's the actual difference between looking rich and being rich? Because let me tell you, they are not the same thing, not even close. So Hallam tells this unbelievable story about a woman he knew. Picture this. She had all the signs of success, right? A $250,000 Jaguar, a flashy Rolex on her wrist, a massive house. I mean, she looked like a millionaire through and through. But then when she wrote him a check for just $150, it bounced. She literally didn't have the money in her account. And that story right there perfectly illustrates our first big idea, the illusion of wealth. You know, we're all kind of trained to see the fancy cars and the expensive watches as these ultimate signs of success. But as Hallam points out, a lot of the time, it's just an act. It's a performance that's completely funded by debt. And here's what might be the most surprising part of this whole thing. This advice isn't coming from some Wall Street guru in a slick suit. Nope. Andrew Hallam is a high school English teacher. Think about that. He didn't have some huge salary. He didn't inherit a ton of money. He just followed a few simple rules, and that's how he built real, lasting wealth. So when he says wealth, what is he actually talking about? Well, it's definitely not about owning a Ferrari. It's about one thing, freedom. Hallam's definition is super clear, and I love it. He says it's having enough money invested so that those investments generate an income that's at least double what the average family in your country makes. That's the point where you could literally choose to never work again. Okay, so how on earth do you get that kind of freedom? It all starts with the very first rule from the Millionaire Teacher, which is spend like a real millionaire. And I can pretty much guarantee it is not what you're thinking. All right, let's do a quick quiz. What do you think the average millionaire in the US spends on a car? 100 grand? 75? More? Okay, get ready for this. The median price they actually pay is just over $31,000. Seriously. Oh, and it gets even more surprising. The #1 most popular car brand for American millionaires, it's not BMW, it's not Mercedes, it's Toyota. Even Deca millionaires, we're talking people with over 10 million bucks, they only spend about $42,000 on their car. And Warren Buffett, one of the richest guys on the entire planet, his most expensive car ever cost him just $55,000. You know, Hallam learned this exact lesson from a millionaire mechanic he knew named Russ, and Russ just put it perfectly. He said, if you're trying to become wealthy and you make those kinds of purchases, you'll never get there. Never. It's a total trap. All right, so if you're saving all this money by not buying flashy cars, what are you supposed to do with it? Well, that brings us right to rule number 2. You need to use your single greatest investment ally. In fact, this thing is so powerful that Albert Einstein supposedly called it the most powerful force in the universe. What was he talking about? Compound interest. It's a pretty simple idea, really. It just means your money earns money, and then that money starts earning even more money. It creates this unstoppable snowball effect that just gets bigger and bigger over time. You know, the best way to really wrap your head around this magic is with a quick story. Let's meet 2 investors, Star and Lucy. Star starts investing just $45 a month when she's only 5 years old. Her friend Lucy, on the other hand, waits until she's 40. But to make up for lost time, she invests a whopping $800 every single month. So over her entire lifetime, Star, our super early investor, puts in a grand total of $32,400, okay? Just remember that number. Now, let's look at Lucy. She started way later but invested a ton more money. She puts in a staggering $240,000. I mean, that is almost 8 times more money than Star put in. All right, so here's the big question. Who do you think ended up with more cash at retirement? Was it the person who invested just a little bit but for a really long time? Or the person who invested a whole lot but for a much shorter time? The winner is Star. And it's not even close, it is a landslide. Even though she invested almost $200,000 less than Lucy did, she ended up with over $230,000 more when it was time to retire. And the reason is so simple. Her money just had decades longer to do its compounding magic. Time. That's the real secret ingredient here. Okay, so you're spending like a real millionaire, and you're starting as early as you can. But the big question remains, what do you actually invest in? Well, that leads us to our third and final rule. And it's a strategy so simple, it actually lets you beat the pros at their own game. The secret? It's something called an index fund. Now, an index fund is nothing fancy. It's a single, super simple investment that doesn't even try to pick winning stocks. Instead, it just buys a tiny little piece of every company in the market. Think of it like buying the entire US stock market in one go. The goal is just to match the market's average return. And the best part? It does it with ridiculously low fees. And hey, you don't have to just take my word for it. Who recommends this super simple strategy? Oh, just the most successful investor of all time, Warren Buffett. He has been saying this for decades, that for pretty much all of us, the absolute best and smartest way to invest in stocks is through a low-cost index fund. And it's not just Buffett either. We're talking Nobel Prize-winning economists who all agree. In fact, Merton Miller went so far as to say that any pension fund manager who doesn't have most of their money in index funds is basically guilty of malfeasance. I mean, wow, the evidence is really just that overwhelming. So why are they all so passionate about this? It's because the traditional investment game, well, it's kind of rigged against regular people like us. These actively managed funds, they charge you super high fees, many of them hidden, to pay for professional stock pickers who, and study after study confirms this, fail to beat the plain old market index 96% of the time in the long run. It's crazy. Index funds, on the other hand, have super low fees and just give you the market's return, which, it turns out, is a winning move. So let's bring this all home. The path to wealth that the Millionaire Teacher lays out is actually pretty simple. It boils down to 3 big rules. Rule number 1, spend like a real millionaire, which means modestly. Rule number 2, start investing early. Time is your absolute superpower. And rule number 3, use low-cost index funds. You can beat the pros simply by not playing their expensive game. You know, at the end of the day, this isn't about being some kind of genius or just getting lucky. It really just comes down to discipline, patience, and understanding these few basic rules. The journey to building real, lasting wealth, it all starts with just one step. So the only question left for you is, what's that first step going to be?
Have you ever wondered what it really means to be rich? We see all the signs, right? The fancy cars, the giant houses. But what if I told you that most of what we think of as wealth is just an illusion? Today, we're going to pull back the curtain on the surprising gap between looking rich and actually being rich. And honestly, it might just change the way you think about money for good.
This quote right here, it just hits the nail on the head. It perfectly captures that trap of looking the part while being completely tied down by debt. It's a shiny facade, but it's built on a really shaky foundation. So let's dive in and see what's really going on behind that curtain.
Okay, let's get into it. To really understand this whole illusion of wealth, there's nothing better than a real life story. And trust me, this is a classic case of things not being what they seem. So picture this. Our source author is working as a tutor over in Singapore. One of his clients, the mother of a student, seemed to be living the dream. I mean, on the surface, this family was the absolute picture of success.
You know the type I'm talking about. They had all the stuff. A brand new Jaguar that cost more than $250,000, a massive, sprawling house, a fancy Rolex, and get this, her husband was a high-powered investment banker, raking in a huge salary. By all accounts, these people were loaded.
So a few weeks of tutoring go by, and it's time to get paid. The woman writes a check for $150, and as she's handing it over, she's casually talking about their latest luxury vacation. Everything seems totally normal, right up until the moment it wasn't. And then, the whole illusion just shattered. That $150 check, it bounced. And this wasn't just a one-time mistake either. It happened so often that the author actually had to stop tutoring her son. This supposedly super rich family couldn't even cover a tiny bill like that. You know, that story isn't just some crazy isolated incident. It's actually a symptom of a much, much bigger problem. This culture of consumption that gets people stuck on what you could call a debt treadmill. It's kind of like that old Greek myth about Sisyphus, you know? The guy who was cursed to push a giant boulder up a hill forever, only to have it roll right back down every single time he got near the top. Well, for a lot of us, that boulder, it's debt. We just keep working and pushing, but we never really seem to get ahead.
And here's how that treadmill works. It starts small. You buy a new dining room table on your credit card. But oh wait, now your old plates look kind of sad, so you've got to upgrade those too. Well, now the couch looks all out of place, so you need a new one of those. Before you know it, one purchase leads to another, and that boulder of debt just rolls right back down on top of you. It's a vicious cycle.
So it really makes you wonder, right? If it's not the Jaguar, not the big house, not the Rolex, then what is true wealth? How are we supposed to define it if all the things we associate with being rich can just be a mirage?
Okay, let's cut through the noise. True wealth isn't about how much money you make, it's about how much money you keep. It's having enough assets, things like stocks and real estate, that generate enough income for you to live comfortably without ever having to work another day in your life. Our source suggests a great benchmark: having enough investments to generate at least twice your country's median household income. Now, why twice? Well, that gives you a serious safety net. It's not just enough to get by, it's enough to ride out a bad market and to give you real freedom. That's it. It's financial freedom, not a flashy lifestyle. Just look at this comparison. On one side, you've got a guy who earns $600,000 a year. He's leasing a Ferrari, living in a mansion with a huge mortgage. But he is one bad month, one layoff, away from losing everything. On the other side, you've got someone with a pretty modest lifestyle, but they have a $2.5 million investment portfolio. They're totally free. Now, who would you rather be?
So this is where it gets really, really interesting. If the truly wealthy people aren't the ones buying the Ferraris and the mansions, then what in the world are they spending their money on? The answers are going to surprise you.
Get this. A whopping 90% of American millionaires live in homes that are worth less than $1 million. So who's buying all those multi-million-dollar McMansions? It's often the people who are just trying to look rich, not the people who actually are.
And it's the exact same story with cars. The average millionaire spends about $31,000 on a car. Think about that. That's less, way less than what a lot of people who are drowning in debt spend on their so-called dream car.
All right, that leads to a fun little pop quiz. Forget about the BMWs, the Audis, the Mercedes-Benzes. Just take a guess. What do you think is the single most popular #1 car brand for actual millionaires in the United States? Yep, Toyota. Kind of surprising, right? But it's a perfect window into the millionaire mindset. See, there's a psychology here. They're playing the long game. They prioritize value and reliability over the short-term buzz you get from flash and status. They're not trying to impress their neighbors. They're trying to build a secure financial future for themselves.
So, what's the big lesson here? How can we apply all of this to our own lives? Well, the whole principle is actually pretty simple, but it is so powerful. You have to shift your mindset. You have to stop spending to look rich and start spending to become rich. The author was once told this by his mentor, a millionaire mechanic of all people. He said, if you're trying to become wealthy and you make those kinds of purchases, you'll never get there. Never. It's a pretty blunt way to put it, but man, is it true.
So, let's boil it all down. What's the big takeaway? It's this. True wealth is about freedom, not about having a bunch of stuff. The surest, most proven way to get there is to spend less than you make and invest the rest. It's really that simple. It's about changing your perspective, being happy with what you've got, and realizing that every single day your spending is a choice.
So I'll just leave you with this one last question to chew on. Take a hard look at your own habits and ask yourself, are you spending to look rich or are you spending to be rich? The answer just might change your life.
Welcome to The Explainer. Today, we're going to break down the single most powerful financial concept you were never taught in school. And honestly, it could completely change your financial future.
Let's kick things off with this really powerful idea from, one of the richest investors on the planet, because it's the key to everything we're about to talk about. It's all about preparation, and more importantly, when you start preparing. That's what makes all the difference.
Okay, so we all sat through those math classes, right? Learning stuff like quadratic equations that, let's be real, we were never going to use again. But buried right there in those same textbooks was this incredibly simple idea that could have literally made us rich, and it's called compound interest.
And look, this isn't just some dusty old theory. It's like a force of nature. It's created unbelievable wealth. And the best part, it's accessible to absolutely anyone. You don't have to be a genius to use it, not at all. You just have to get how it works.
All right, let's get into the nitty-gritty. I want you to watch what happens to just $100, a small, almost insignificant amount of money, and see how it just starts to snowball over time. We're going to use a simple $100 bill to watch the magic happen. So after 5 years, it's grown a little bit. That $100 is now about 161. And yeah, that's nice, but we're just getting started. The real engine of this whole thing hasn't even warmed up yet. Okay, fast forward 20 years. Now, that same $100 is worth more than 6 times what we started with. See? The snowball is starting to pick up some serious speed. This is where your interest starts earning its own interest. Whoa. Okay, look at this jump. 50 years later, that little $100 bill is now worth over $11,000. The growth isn't just steady anymore, it's explosive. This right here is the magic moment. It's where the money your interest is earning completely blows past your original investment. Your earnings are doing all the heavy lifting now. And just look at this. After 70 years, that single $100 bill has turned into almost $80,000. That is the power of compounding. It's this incredible force that rewards patience and, the most important thing of all, getting an early start.
So you see the crucial point here, right? Starting is everything. Which brings us right back to that quote about Noah's Ark. The whole point isn't just building the ark, it's about building it before the rain even starts.
You know, that story isn't really just about a flood. It's a metaphor for the catastrophic cost of waiting when you know a storm is on the horizon. And in the world of finance, that storm we're all preparing for, it's retirement. And the time to start building your ark is right now. So let's see this in action. I've got a story for you that just brilliantly shows how starting early can almost defy logic, how you can actually invest less and end up with more. Okay, so let's meet 2 friends. First, there's Star. She starts investing just a tiny amount as a kid. We're talking $45 a month. Then you've got her friend Lucy. She's a high-earning banker, and she starts investing a much bigger chunk of change, $800 a month. But she gets started way later in life. So, who do you think retires with more money? The answer seems pretty obvious, doesn't it? I mean, the person investing over 17 times more cash every month should end up with more. But let's actually look at the numbers. So over their entire lives, Star only invests a total of about $32,000. Lucy, on the other hand, she puts in nearly 8 times that amount, almost $250,000. And here is the absolutely incredible result. Star, the one who started super early with just a little bit of money, she retires with over $1 million. And Lucy? Well, despite pouring in all that cash, she ends up with over $200,000 less than Star. It's just proof that in this game, time is way more valuable than money. Okay, so seeing numbers like that is one thing, but actually making it happen for yourself, that's a whole different story. So how can you put this Noah principle to work in your own life? Well, good news, you don't need a fancy finance degree. It all starts with a super simple, actionable plan. But before you even think about investing a single dollar, there is one non-negotiable step. You absolutely have to do this first, because if you get this part wrong, it can completely sabotage all of your hard work. I'm talking about high-interest debt. If you have credit card debt, paying that off is the single best guaranteed financial move you can possibly make. Think about it. Investing while you're carrying that kind of debt is like trying to fill a bucket that has a massive hole in the bottom. You just can't out-earn an 18 or 20% headwind. It's impossible. Okay, so once that high-interest debt is gone, here's what you do. 3 simple steps. Step 1, track everything. For 3 months, just write down everything you spend. You got to see where your money is actually going. Step 2, find your number. Subtract what you spend from what you make and see how much you can realistically invest. And step 3, this is the big one, pay yourself first. Automate it. Set up a transfer to your investment account for the day you get paid, not at the end of the month. So you might be thinking, okay, this all sounds great, but what am I even investing in? I get it. The stock market can sound super intimidating, but it's actually way simpler than you think. Let's break it down with a story pretty much everyone knows. All right, so think about it like this. Owning a stock just means you own a tiny, tiny piece of a business. Let's say Willy Wonka needs cash to grow his amazing chocolate factory. So what does he do? He sells off little pieces of his company, we call them shares or stock, to investors like you. He uses that money to build a bigger, better factory and make even more profit. And as those profits grow, you, as a part owner, get a piece of that success. You can get paid in cash, those are called dividends, and as the whole business becomes more valuable, the price of your little piece goes up too.
And this is what that looks like over the long haul. This chart shows the insane potential. Based on the historical average return of the US stock market, a single $1,000 investment, just $1,000, could grow to over $5 million in 90 years. That's the power of business growth and that magic of compounding, all working together.
So here's the bottom line. The single most powerful ally you have in all of this is time. And you will never, ever have more of it than you do right this second. The math is clear, the principle is proven. The only question left is, what are you going to do about it? You'll never be younger than you are today, so when are you going to start building your ark?
So picture this. It's 1971. You've got the undefeated heavyweight champion of the world, Muhammad Ali, and he gets a public challenge from basketball superstar Wilt Chamberlain. Seriously, it was the ultimate pro versus amateur showdown, and Wilt was totally convinced all he needed was one lucky punch. But come on, the rest of the world knew better, right? I mean, in just about any field you can think of, a seasoned pro has a massive, overwhelming advantage over an amateur. You wouldn't challenge a chess grandmaster or a top lawyer to a match in their own arena. It's just common sense. But what if there was one, just one, exception to that rule? An arena where an average person with just a little bit of knowledge can consistently, and I mean consistently, outperform the highly paid experts. Well, that arena? It's the world of investing. To understand how that's even possible, we first need to pull back the curtain and meet the Goliath in this story, the financial services industry. You see, the game is often rigged against the little guy, the average investor, because of a massive fundamental conflict of interest. As an investor, you've basically got two main choices on the menu. On one side, you have actively managed funds. This is where a fund manager tries to be a hero, picking and choosing stocks, trying to beat the market. And on the other side, you've got simple, low-cost index funds. So what in the world is an index fund? Well, think of the entire stock market as this giant book. An index fund is kind of like the index in the back of that book. It doesn't try to pick out the best chapters or the most exciting pages. It just holds a tiny little piece of every single page, giving you ownership across the whole shebang. You know, this Dilbert cartoon just perfectly captures the industry's dilemma. It asks a fantastic question. If index funds are so great, why don't more people use them? And the punchline is, well, it's painfully simple. There's just not a lot of money to be made by financial advisors who recommend them. And that right there gets us to the absolute heart of the problem. The reason actively managed funds are so incredibly profitable for the industry is because of fees. We're talking about tiny little percentages that pack enormous punches and just slowly, quietly bleed your returns dry over time. So let's break down these hidden punches, shall we? There are 5 main culprits that drag down your performance. You've got expense ratios to pay the manager, 12B1 fees for marketing, you got trading costs from all the constant buying and selling, sales commissions, and finally, the taxes that get created by all that activity. And you know the worst part? Most of these are totally invisible on your statement. Okay, let's just focus on one of those, a typical expense ratio for an actively managed fund. It's about 1.5%. Sounds tiny, right? Almost trivial. But here's where your jaw hits the floor. On a big, say, $30 billion fund, that tiny 1.5% fee works out to $450 million. That's money skimmed right out of investors' pockets every single year. That's money that isn't growing for you, it's paying for somebody's fancy office and enormous salary. And that quote just says it all, doesn't it? It perfectly sums up the amateur's disadvantage. When you add up all 5 of those different fees, you're basically starting the race with weights on your ankles. It's like asking your opponent to hit you 5 times before the opening bell even rings. Okay, so if the professional's game is riddled with all these costly traps, what's the amateur's secret weapon? What's David's slingshot in this fight? Well, it's that humble index fund. And hey, don't just take my word for it. Let's see what some of the smartest financial minds on the planet have to say. Let's start at the very top. The most successful investor of all time, Warren Buffett. His advice? It's crystal clear. No messing around. The best way to own common stocks is through an index fund. For him, the debate is just over. And look, this isn't just some clever saying from a famous billionaire. It's backed up by serious academic firepower. Paul Samuelson, the first American to ever win the Nobel Prize in economics, came to the exact same conclusion. And his key word there is efficient. You get the market's return without all that expensive baggage. Then you've got another Nobel winner, Daniel Kahneman, who's even more blunt. I mean, he doesn't mince words. When he was asked about the chances of someone picking funds that can consistently beat the market index, his answer was simple and final. They're just not going to do it. It's just not going to happen. And maybe, just maybe, the most telling endorsement of all comes from inside the industry itself. Even the superstars, legendary fund managers like Peter Lynch and Bill Miller, guys who got famous for beating the market, they both admit that for the average person, index funds are the smartest choice. So right about now, you might be hearing a little voice in your head, that classic counter-argument. A financial advisor might say, sure, okay, most funds fail, but I'm a professional. I can pick the winners for you. All right, let's put that claim to the test. The pitch is always the same, isn't it? They'll show you these funds with a fantastic track record, funds that have earned a top 5-star rating from a research firm like Morningstar, and the implication, of course, is that this past success is going to continue long into the future. So, what does the actual data say? Well, if you had invested $100 back in 1994 and you only held these top-rated 5-star funds, 10 years later, you would have had $194. Not bad. But if you just put that same money into a simple total stock market index fund, you'd have ended up with $283. But hold on, because the only number that really, truly matters is what you actually get to keep after taxes. And here, well, the difference is staggering. That 5-star strategy left you with just $165, while the simple index fund grew to $271. Why? Well, all that constant buying and selling in active funds creates huge tax bills that just eat away your real returns. So the takeaway here is brutally simple. In the world of mutual funds, past performance means absolutely nothing. A fund that was a star last decade is just as likely to be a total dud in the next. It's a trap. Past performance simply does not predict future results, period. All right, so after seeing all the evidence, what is the winning strategy for the amateur investor? What's the playbook? It really comes down to a few simple but incredibly powerful ideas. Okay, first, owning the entire market through low-cost index funds gives you the absolute best odds of winning. Second, you just have to accept that no one, not even the pros, can reliably pick winning funds ahead of time. Third, ignore past performance. It's just noise. And finally, always be aware of that conflict of interest that sits right at the heart of the financial industry. Look, the financial industry is built on complexity and the belief that you, the amateur, need their expensive guidance to succeed. They are literally betting that you'll never learn how simple winning can actually be. But now you know. You know the secret. So the only question left is, what are you going to do about it?
When it comes to investing, we're always told to watch the market, right? To fight the volatility, to beat the system. But what if the real enemy isn't out there at all? What if the biggest battle is actually right here, with the person staring back at you in the mirror? Today, we're going to dig into that. Let's do it.
So let me just ask you this straight up. What if your biggest roadblock to building real wealth is you? What if all the things we think we're supposed to do, watching the news constantly, reacting to every little market swing, trying to be the smartest person in the room, is the very thing sabotaging us? It's a pretty tough thought, but it is the absolute core of what we need to understand.
The author Andrew Hallam puts it perfectly. He kind of compares it to the movie Fight Club, where the main character is, literally fighting himself. For us as investors, it's not a fist fight, but it's an emotional war. We become our own worst enemies, and we're driven by two of the most powerful forces out there, fear and greed.
And look, this isn't just some philosophical idea. This internal war has a real, quantifiable, and honestly, a pretty shocking financial cost. So let's actually look at the numbers behind this self-sabotage.
Okay, so check this out. According to data from Vanguard's legendary founder John Bogle, the average mutual fund returned about 10% a year over a 25-year stretch. But the average person invested in that exact same fund only made 7.3%. Wait, what? How is that even possible? How can you underperform the very thing you own?
Well, the answer is depressingly simple. It's just human nature. When a fund has an amazing year and everyone's talking about it, we get that FOMO, that fear of missing out, and we pile in. We buy high.
But then, when that same fund has a rough year, we get scared, we panic, we pull our money out, or we just stop investing. We sell low. We are literally hardwired to do the exact wrong thing at the exact wrong time.
And here it is. Here is the actual price tag for that emotional behavior. If you'd invested $50,000 and just let it grow at the fund's actual 10% return, it would have turned into over $500,000. But at the 7.3% that investors actually got by jumping in and out, it's less than $300,000. That gap, over $250,000, that's not a market loss. That's the price of panic.
So this really shows the two different mindsets. On the left, you've got the average investor, just riding that emotional roller coaster. But on the right, you have the evolved investor. This person thinks completely differently. They don't just put up with market dips, they actually love them. Why? Because they understand that a falling price just means they get to buy more of a great thing for the same amount of money. It's a sale. And that is the mindset we've got to build.
So, how do we become that evolved investor? How do we make that switch? Well, it all starts with a really powerful mental model, a real aha moment that can totally change the way you look at the market. And it's called the dog on a leash theory.
Okay, just picture this. You're out walking a very, very energetic dog on a super long leash. Now you, the owner, you're just walking in a straight line at a nice, steady pace. But the dog? Man, that dog is all over the place. It's darting ahead, it's lagging behind, sniffing everything. Total chaos. But no matter how crazy it gets, it's always tied to you. It can never truly get away. So in this metaphor, that frantic dog is the day-to-day stock price. It's irrational, emotional, totally unpredictable. But you, the owner, you represent something much more solid and stable, the actual underlying business earnings, the real profits. And here's the key. Over the long run, the stock price has to follow the earnings. That leash always pulls it back eventually.
It's a cool story, right? But does it actually hold up in the real world? Oh yeah. Let's take a look at what happens when investors completely forget about the owner and start focusing only on that frantic, sprinting dog. This chart of Coca-Cola just shows it perfectly. See that dashed line? That's the owner, the company's earnings, just steadily growing. Now look at the solid line. That's the dog, the stock price. And in the 90s, that dog went absolutely wild, sprinting almost 1,000% ahead, while the owner only grew about 300%. What happened next was inevitable. The leash tightened, and that price got yanked right back down to reality.
And look, this wasn't some one-time fluke with Coca-Cola. As Mark Twain supposedly said, history has a certain rhythm to it. This pattern of the dog getting way out ahead of the owner, it happens over and over again, about once every generation.
Just look at this pattern. In the Roaring '20s, stock prices, the dog, grew more than twice as fast as the business earnings, the owner. The result in the next decade, a 40% beatdown. How about the 50s and 60s? Same story. The 90s? Yep, you guessed it. Every single time the dog sprints too far ahead, the next 10 years are spent with that leash pulling it back, which means terrible returns for anyone who bought at the peak of all that hype.
And of course, there is no better, crazier example of this madness than the dot-com bubble of the late 90s. I mean, this was a time when investors weren't just ignoring the owner, they were betting on dogs that didn't even have an owner. A lot of these companies had zero earnings, zero profits. So just imagine you got swept up in all that excitement. It's the year 2000, and you decide to invest a cool $10,000 in one of the hottest tech stocks of the day, a company called Nortel Networks. So what was that 10 grand worth? Just a couple of years later? $30. Not 30,000, 30. The author himself admits he got totally burned on this exact stock. He made that classic mistake. He was watching the dog, not the owner. And Nortel wasn't some one-off thing. The damage was just everywhere. A $10,000 investment in Amazon at the peak crashed down to $700. In Cisco, it fell to under $1,000. This is the brutal price of chasing hype instead of focusing on the steady and sometimes boring reality of business profits. Okay, so that's the scary part. The crucial question is, how do we avoid that fate? How do we take this knowledge and use it to our advantage? We have to adopt that winning mindset. So let's look at how an evolved investor actually thinks. Warren Buffett, of course, put this perfectly. He asked a really simple question. If you're going to eat hamburgers for the rest of your life, do you want the price of beef to go up or do you want it to go down? The answer is obvious, right? Of course you want it to be cheaper. And that right there is the huge mental shift we have to make. If you are going to be a buyer of stocks for the next 10, 20, 30 years, why on earth would you want them to get more expensive? A market crash isn't a crisis for you, it's a sale. It's Black Friday for your entire portfolio. You get to buy the same awesome companies, just at a massive discount.
So here's the playbook. This is how you turn that widespread fear into personal profit. Step 1. A crisis hits. Fear is everywhere, and prices are plummeting. The dog is scared and running for the hills. Step 2. You have to consciously take a deep breath and remember the owner. Ask yourself, is this crisis really going to destroy the earnings of great businesses forever? The answer is almost always a big fat no. And that leads to step 3, buy the sale. You take advantage of that temporary gap between the frantic dog and its steady owner.
So, I'll leave you with this. The market will, without a shadow of a doubt, crash again. It's not a matter of if, it's just a matter of when. And when that day comes and everyone around you is panicking, are you going to be conquered by that enemy in the mirror? Or are you going to see what's really happening, the sale of a lifetime?
All right, let's talk about building some serious wealth. I mean, mountains of money. But we're going to do it the smart way, with a responsible portfolio. Because, let's be real, that's the only way to grow your money and actually sleep at night. You know, it kind of reminds me of what my parents used to say. Eat your Brussels sprouts. They're good for you. We've all heard that, right? In the world of investing, stocks are basically the Brussels sprouts. Everyone tells you they're essential for healthy, long-term growth. But just imagine for a second, eating nothing but Brussels sprouts, breakfast, lunch, dinner, just sprouts. You wouldn't feel so great, would you? It's the exact same thing with your investments. A portfolio that's 100% stocks, well, that's not balanced. It's actually a recipe for disaster. And this, right here, brings us to what I like to call the Brussels sprout problem. It's the fundamental issue with just piling all your money into stocks and crossing your fingers. A portfolio with only stocks is a total roller coaster. I mean, when the market is soaring, you feel like an absolute genius. But when it crashes, and it always does eventually, your entire net worth goes down with it. Now, if you're 25, that's scary. But if you're 55 and about to retire, seeing their life savings get sliced in half isn't a thrill ride, it's a complete catastrophe. So how do you protect yourself from that kind of terrifying freefall? Well, you pack a parachute. And in your portfolio, that parachute is called a bond. Think of bonds as your safety net. While stocks are doing their crazy volatile dance, bonds are the calm, steady partner. They don't get shaken and stirred by all the drama. They're not going to give you those eye-popping games, but man, they are absolutely crucial for stopping a nosedive during a market crash. So what the heck is a bond anyway? It's actually really simple. You're just giving a loan. You lend your money to a super stable government or a big, reliable company, and in return, they pay you interest. It's one of the safest investments you can make. Okay, so if bonds are all about safety, that raises a pretty logical question, right? Should you hire some expensive Wall Street pro to pick your bonds for you? You'd think so, but the data tells a completely different story. Just look at the proof right here. Between 2003 and 2008, a simple, dirt-cheap bond index fund, that's the bar on the far right, absolutely smoked the professional managers. Why? Look at the other bars. Those high fees they charge just eat away at your returns year after year. The simple, boring index fund is the undisputed champ. Okay, so we're on the same page. We need bonds, and we know that low-cost index funds are the way to go. So let's put it all together. Let's cook up the winning recipe for your portfolio. And you don't need a PhD in finance to figure this out. A fantastic rule of thumb is just your age in bonds. So if you're 30 years old, you put about 30% of your portfolio in bonds. If you're 50, you aim for 50. It's a beautifully simple way to automatically dial down your risk as you get older. So what's this look like in the real world? Well, here's a great model for a 30-year-old. You've got your 30% safety net in a bond index fund. Then your growth engine, your sprouts, are split between a U.S. stock index and an international stock index. Boom! You're globally diversified. It's simple, it's powerful, and it works. Now, this is where things get really, really interesting. Because this balanced approach, it doesn't just protect you, it actually gives you a superpower, the ability to profit from widespread market panic. Check this out. This is a real portfolio during the absolute meltdown of 2008. He started the year with about 35% in bonds. Then, the stock market just imploded. His stocks got hammered, but his bonds mostly held their value. A year later, without him doing anything, his portfolio had automatically shifted to being 55% bonds. The parachute worked perfectly. So, what do you do now that you're sitting on this big pile of safe bonds? This is the genius move. You sell some of those bonds to raise cash, and then you use that cash to buy stocks while they're on a massive once-in-a-decade fire sale. This process, it's called rebalancing. And that's the secret sauce. Rebalancing is a disciplined, automatic system. It literally forces you to do the one thing every investor dreams of doing: buy low and sell high. You're not guessing, you're not panicking, you are calmly using your bond parachute to take advantage of the chaos, setting yourself up for incredible gains down the road. Now, if that 3-fund portfolio still sounds like a bit much, don't sweat it. There's an even simpler strategy that's just as powerful. And honestly, it's got the best name ever: the couch potato strategy. I mean, it doesn't get any easier than this. You split your money 50-50. Half goes into a total stock market index, the other half goes into a total bond market index. That's it. Once a year, you log in, spend maybe 5 minutes rebalancing back to 50-50, and you go back to your life. It is literally investing on autopilot. Okay, but does this too simple strategy actually work? Let's go back to the 2008 crash. The average US mutual fund got absolutely crushed, down over 29%. The couch potato portfolio, it was only down about 20%. That is a huge difference when the sky is falling. And here's the real kicker. Those professional balanced funds, the ones that are supposed to protect you with a mix of stocks and bonds, they did almost as bad as the all-stock funds. What happened? The human managers probably panicked and sold low, exactly what a disciplined, unemotional strategy is designed to prevent. Now, I can still hear some of you saying, yeah, but I'll take the risk for a higher return. But is the extra return really worth it? Look at this data over a 31-year period. A 100% stock portfolio gave you an extra 0.7% per year. That's it. A tiny, tiny reward for a massive amount of extra risk and heartburn. And what does that extra risk feel like in the real world? It feels like this: a drop of over 20% in a single year. The balanced portfolio's worst year was a drop of less than 10%. Which one could you actually stomach without freaking out and selling everything at the absolute worst possible time? And that brings us to the cowboy investor. You've met this guy. He's the one who says bonds are for wimps, chases whatever's hot on the news, and takes on these insane risks. He thinks he's going to get rich quick, but in reality, he's far more likely to get bucked off the horse and end up with nothing. So in the end, it all comes down to a simple choice. Which investor do you want to be? Do you want to be the cowboy, riding the market's crazy ups and downs and risking it all? Or do you want to be the smart investor, the one who packs a parachute, sleeps well at night, and knows how to turn a crisis into an opportunity? I think the answer is pretty clear. So, what if I told you that you could beat over 90% of Wall Street experts with an investment strategy that takes, get this, less than an hour a year? I know it sounds way too good to be true, but it's not. Today, we're going to break down exactly how regular, everyday people are absolutely winning the investment game with a plan that is, frankly, ridiculously simple. You know that feeling, right? Many of us have been there. You try to do the right thing with your money. Maybe you even hire a professional. But you just can't shake this nagging sense that the whole system is rigged to benefit someone else. The fees are a maze, the statements are written in some alien language, and your returns, well, let's just say they're not exactly setting you up for that early retirement. This quote, it's from a doctor named Chris Olson, and man, it just cuts right to the bone, doesn't it? After years of investing, he had this light bulb moment where he realized his hard-earned money was being slowly siphoned away by middlemen through these tiny little fees he barely even knew were there. It's a huge question we all need to ask ourselves. These seemingly microscopic percentages, the ones often buried deep in the fine print, they can add up to hundreds of thousands of dollars over your lifetime. It's like a silent killer for your portfolio, just quietly destroying your financial future. But here's the thing. Instead of just getting mad, Dr. Olson got smart. He decided, you know what, there has to be a better, simpler way. And his journey? Well, it gives us the perfect blueprint to follow. So who is this guy anyway? Chris Olson isn't some Wall Street guru. He's a busy specialist doctor. He does incredible global health work in places like Indonesia and Cambodia. Then, in 2006, he and his wife became parents, 2 triplets. All of a sudden, he desperately needed an investment plan that was no nonsense, effective, and didn't eat up all of his time. And here it is. Seriously, this is the entire strategy. He built a simple portfolio using just 3 super low-cost index funds. One for the entire U.S. stock market, one for the entire international stock market, and one for the U.S. bond market. That's it. The whole shebang. He basically bought the entire world's economy for next to nothing. We're talking maximum diversification for rock-bottom costs. The real beauty here is just how simple it is. He just set his target percentages for each fund, put his monthly deposits on autopilot, and then, and this is the most important part, he only looked at it once a year to rebalance. We're talking maybe 10 minutes of work annually. That's it. Okay, but here's the real test, right? How does a simple plan like this hold up in a complete and utter crisis? Let's look at the 2008 financial crash. So as the markets were flying high in '07, Chris just followed his plan and rebalanced. He sold some of his high-flying stocks to buy more stable bonds. Then the crash hit. While everyone else was panicking and selling, he did the exact opposite. He calmly sold his safe bonds to buy stocks when they were basically on a massive fire sale. And the result? By 2011, his portfolio wasn't just recovered, it was up over 30%. Okay, so the strategy can survive a market nosedive. That's pretty impressive. But how does it actually stack up against the so-called experts? You know, the full-time fund managers with huge teams of researchers who get paid millions of dollars to try and beat the market. I mean, this is the ultimate showdown. A busy doctor spending maybe 10 minutes a year on his finances versus some of the biggest, most respected names in the entire investment world. You'd think he wouldn't stand a chance. Well, the results, they pretty much speak for themselves. Over that exact same 5-year period, which includes the massive crash, Chris's simple portfolio returned almost 31%. The pros? Fidelity returned just 19.4%. T. Rowe Price got 24%, and American funds only managed 13.1%. The doctor didn't just win, he completely crushed them. And get this, there's another hidden win. Think of it this way. These active funds are constantly buying and selling stocks, like a nervous day trader. Every single time they sell a stock for a profit, they create a taxable event that you have to pay for. But index funds, they mostly just buy and hold, so they have a very low turnover, and that means fewer taxes eating away at your money. It's a powerful 1-2 punch. Lower fees and lower taxes. So this worked out great for an American doctor. But was it just a fluke? A lucky break? Not at all. It turns out these core principles, low-cost, diversified indexing, they work pretty much everywhere. Let's head north for a minute, to Canada. In Canada, we meet Keith Wakelin, a landscaper and a long-distance runner. He knew that just like in running, you can't carry any excess weight if you want to win. And in investing, that excess weight is fees. So he built a simple 4-index portfolio. And the results? They were just as stunning. From 2005 to 2011, Keith's simple portfolio beat 4 out of the 5 flagship funds from Canada's biggest banks. It's the same story, just a different country. The everyday investor with a simple low-cost plan comes out on top. But there's a really crucial warning here, and this one comes to us from Singapore. See, the financial industry is clever. They've seen how popular index funds have become, so they created fakes. They're called closet indexers. They're funds that pretty much act like an index fund, but they charge you those high active management fees. And the difference is just staggering. A fee difference of less than 1% on a single $20,000 investment can cost you, wait for it, over $180,000 over a lifetime. That's a house. It just proves the most important point of all. You have to always check the fee. So what if you want to make this even easier? In Australia, a blogger named Nirav Bhatt found the answer. All-in-one funds, like Vanguard's Life Strategy funds. These things bundle multiple index funds into one single package, and they automatically rebalance for you. I mean, this is the ultimate set it and totally forget it solution. Okay, so we've seen the proof from a doctor, a landscaper, and from bloggers all around the world. The conclusion is crystal clear. So let's boil all of this down into a simple winning game plan that you can actually use. It all comes down to these 3 simple rules. First, keep your costs as low as humanly possible. Fees are the single greatest predictor of your future returns. Second, diversify like crazy. Don't try to bet on individual stocks. Just buy the whole market. And third, be disciplined. Stick to your plan, rebalance once a year, and just ignore all the panicky headlines. And if you can do that, if you can just follow those 3 simple rules, well, you put the odds squarely in your favor. You give yourself a greater than 90% chance of beating the professionals at their own game. Just let that sink in for a second. This isn't some secret formula that's only for the financial elite. It's a simple, it's powerful, and it's a proven path that is available to literally everyone. We've seen how a doctor, a landscaper, and people just like you have used it to win. So the only question left is, what's stopping you? All right, let's talk about financial advisors. Today, we're going to pull back the curtain and take a look at the secret playbook many of them use, a playbook that might be costing you a ton of money, and you probably don't even realize it. So you've been working hard, you've saved up a bit of cash, and now you're thinking, hey, maybe I should get a pro to help me invest this stuff. And you know what? That's a totally smart thought. But hold on. Before you sign anything or hand over a single cent, there's something you really need to know about how this industry works. You see, the thing is, a lot of these advisors, they're working from a playbook. And here's the kicker. The number one goal of that playbook isn't always to make you the most money. Nope. It's often about selling you certain products, expensive funds that line their pockets. So let's crack it open and see what's inside. First up, let's dive right into the advisor's playbook. We're going to look at the most common sales pitches, the lines they use to get you to buy what they're selling. Okay, play number 1 is all about fear. It goes something like this. Oh, you don't want a simple index fund. What happens when the market crashes? You need an active manager, a real person picking stocks to protect you. It sounds so logical, right? So comforting. But here's the reality check. These guys can't time the market. And we have the data. During the huge 2008 crash, a big study by S&P found that almost all of these so-called expert managers, they still lost to their simple index fund counterparts. So much for protection. They basically went down with the ship just like everybody else. All right, here's another classic line you'll hear. They'll call index funds average. They'll look you in the eye and say, why would you settle for an average return? Our expert team can pick the winners for you. The whole argument sounds pretty good until you realize it only works in a complete fantasy world, a world where costs just don't exist. And just look at what that fantasy world would look like. For you to just get that average return, your advisor would have to work for free. The fund company? A charity. The researchers? They're doing it for fun. The fund managers? Yep, free. And oh yeah, all stock trades are free, and the government doesn't take any taxes. I mean, come on. In the real world, all those costs pile up, and they take a huge bite out of the returns from those fancy active funds. It's actually a big reason why cheap index funds usually win in the long run. So you see the problem. With all those costs, the only way an expensive fund makes sense is if your advisor is some kind of genius who can pick the winning funds ahead of time. But here's the big secret. Nobody can do that reliably. And you don't have to take my word for it. Get this. This quote is from the director of research at Morningstar, the company famous for rating funds. He basically said, you probably shouldn't even pay attention to their own ratings. Think about that. If the guys at Morningstar are telling you they can't pick the winners, what makes you think the advisor down the street can? Okay, so the products themselves are questionable. But what about the people selling them? Who are these experts giving you advice, really? Let's imagine a totem pole of financial knowledge, right? Way up at the top, you've got the real heavy hitters, the managers of huge pension funds, the hedge fund wizards. These are the actual pros. And then, way down at the bottom, well, that's where you'll find most financial advisors and brokers. It's like Suze Orman said, they're often just salespeople in fancy suits. So, how much training does it take to become one of these experts? Brace yourself for this one. To get a license to sell mutual funds, sometimes the training is as short as 2 weeks. Seriously, 2 weeks. That's it. We heard from one broker who said his training was basically 3 weeks of learning how to sell. He said if he actually wanted to learn the important stuff, how to build a diversified portfolio and manage risk, he had to go learn that on his own time. So what does that tell you? The focus is on sales, not on making you a smart investor. Okay, so if the local advisor is mostly a salesperson, who should we be listening to? Well, let's just follow the smart money. Let's see what the real experts, the folks at the top of that totem pole, are doing with their cash. Okay, check this out. It's fascinating. A study tracked 192 massive corporate pension plans for 17 years. Now, these are managed by the absolute best in the business, the titans of the industry. And the result? Over 70% of them, 70, couldn't even beat a dead simple portfolio of basic stock and bond index funds. So let me ask you, if the best in the world can't beat the market, why do we think our local advisor can? And you know what? A lot of these pros have basically given up trying. They know the game is stacked against them because of all the fees and costs. Just look at some of the biggest pension funds in America. They're responsible for billions of dollars for teachers, firefighters, state workers, and they have huge chunks of their money, sometimes almost all of it, in simple index funds. They're not trying to be heroes. They're just following the data. This next story just pulls it all together perfectly. Picture this. It's 2004 and Google has its massive IPO. Suddenly, thousands of regular employees are millionaires overnight. And you can probably guess what happened next, right? The financial planners smelled blood in the water. They descended on Google's headquarters like sharks, ready for a feeding frenzy. But Google did something amazing. Before letting the sharks in, they decided to educate their people. And they didn't mess around. They brought in an all-star team, a Nobel Prize-winner, a famous Princeton economist, and the literal founder of Vanguard, John Bogle. And what did these legends tell all the new Google millionaires? The message was exactly the same from all of them. Don't try to beat the market. Just buy low-cost index funds. And be really, really careful of advisors trying to sell you expensive stuff. So what happened? Well, when those well-dressed financial planners finally got in the door, the Google employees were ready for them. They were armed with the best knowledge in the world, and they could see right through all the slick sales pitches. It just goes to show you, knowledge really is the best defense. Okay, so let's bring this all home. What's the winning move for you? How do you take all this and use it to take control of your own money? First things first, you have to understand the conflict of interest. It's so simple. If your advisor gets paid a big commission for selling you expensive funds, asking them about cheap index funds is pointless. They don't make any real money on those. The analogy here is perfect. It's like walking into a McDonald's and asking the manager to recommend a good Whopper. It's just not going to happen. And look, if you need one final push, just listen to Jack Meyer. This isn't some random guy. He's the man who ran Harvard's gigantic endowment fund for years. We're talking billions and billions of dollars. And he calls the investment business a giant scam that just sucks away money in fees. His advice is as blunt as it gets. You should simply hold index funds, no doubt about it. I mean, when one of the most successful money managers on earth says that, you should probably pay attention. So we're going to leave you with one final thought. The next time you're sitting across from a financial advisor or even just thinking about it, ask yourself this one simple question. Is this person really on my team, or are they just running plays from their own book for their own benefit? Answering that question honestly, well, it could completely change your financial future. All right, let's talk about some of the most seductive and frankly, dangerous traps out there in the investment world. And our guide for this little journey? It's not some stuffy textbook. Nope. It's a powerful and painfully honest personal story about how greed can blind even the most skeptical of us.
You know, the author of the book we're drawing from kicks things off with this brutally honest confession. And I think it's just perfect. It's a great reminder that, hey, everybody makes mistakes. The key, though, is to learn from them. And today, we're going to learn from his.
So what kind of promise could be so tempting, right? Well, it all started with this number right here, 54%. I mean, think about that. A 54% annual return? It's just an unbelievable, astronomical figure that should set off every single alarm bell you have. But, as we're about to see, sometimes seeing is believing. And yeah, this brings us to the story of a company called Instacash Loans. This isn't some hypothetical. This is a real first-hand account of how a seemingly smart investor got slowly but surely drawn into a super high-risk scheme over several years, all because of that unbelievable promise. Okay, to really put this into perspective, at the exact same time, there were these WorldCom bonds out there offering 8.3%, and that was considered dangerously risky. Like, this company might be in serious trouble risky. Now, compare that to 54%. That's not just a red flag. That's a whole fireworks display going off. And yet, that temptation was incredibly powerful. And look, this wasn't some snap decision. This happened over 5 years. In 1998, our author was totally skeptical. He called it a scam, just like you or I would. But then, he watched his friend get paid out. Not once, but year after year. This is a classic, powerful psychological trigger called social proof. You see your friend getting rich, and it just slowly wears down all your defenses until, bam, greed finally takes over. So how on earth did they justify these returns? Well, the guy in charge, this Daryl Klein, he had a really compelling story. It was this seemingly plausible business model that, okay, it was kind of predatory, but it sounded like this well-oiled machine. He'd say, oh, I'm just loaning money to people with bad credit. I take their cars as collateral, charge massive fees. It's a perfect example of what's called the narrative fallacy. Our brains are just wired to believe a good story, even when the math makes absolutely no sense. But of course, this was all a fool's paradise. And in 2006, the party ended. It all came crashing down. The author's $7,000? Gone. His investment club's entire $25,000? Vanished. That seemingly efficient operation was nothing more than a house of cards. So what was it really? A classic Ponzi scheme. You've heard of Bernie Madoff, right? It's the same exact playbook. Instacash loans wasn't making any real profits. They were just using the money from new investors to pay off the earlier ones. And as soon as that new money dries up, the whole thing just implodes. Okay, so here's the really crucial point. This isn't just a story about one single crazy scam. The very same psychological triggers, that social proof, those compelling stories, the fear of missing out, they show up all the time in much more common, even seemingly legitimate investment products. The kind of stuff you might see every single day. Let's take investment newsletters, for example. This is a real promotional claim from something called the Gilder Technology Report, 155% return over 3 years. I mean, that sounds incredible, doesn't it? It's perfectly designed to tempt you, to make you feel like you're missing out on some secret to getting rich quick. But, and this is a huge but, this is the danger of cherry-picking data. See, these were some of Gilder's top picks right before the dot-com bubble burst. If you put $40,000 into these 4 stocks, just 2 years later, you'd have been left with a little over $1,000. That's the catastrophic loss they conveniently forget to mention in the ads. And in fact, the overall track record for these newsletters is, well, it's abysmal. An academic study actually tracked over 15,000 of them and found that 94% went out of business over a 12-year period. I mean, think about it. If they really had a secret formula for wealth, would they be failing at such an incredible rate? All right, what about something that feels ancient and safe, like gold? It's always being pushed as the ultimate safe haven, right? But just look at this chart. Over 200 years, $1 invested in gold grew to just $73. Okay, but that same dollar in the US stock market, it grew to over $10 million. The data couldn't be clearer. Gold is not a long-term investment. It's a speculation. And this whole tactic of selling a seductive story, whether it's pure hype or supposed safety, it's not just limited to newsletters. It's actually the core business model for a lot of mainstream financial magazines. So what are they really selling you? A lot of the time, it's not sound advice. It's a product designed to tap into our most powerful emotions, fear and greed. Just take a look at this. This is a Smart Money magazine cover from April 2009. Now remember what was happening then. It was the absolute bottom of the financial crisis. The stock market was basically on sale at a massive discount. And what were the headlines screaming? Protect your money, buy gold, buy bonds. They were pumping fear when the smart move, the brave move, was to buy. And this chart right here shows you the actual cost of following that fear-based advice. So yeah, the bond funds they recommended did okay, about 33%. Gold did even better, 46%. But the World Stock Index, the very thing they were telling everyone to run away from, it surged by 70%. See, they sold readers what they wanted to hear, not what they needed to do. Okay, now let's talk about this supposed investment vehicle for the ultra-wealthy. Hedge funds, right? They're always surrounded by this aura of exclusivity and genius. But are they really the superior choice they claim to be? Well, the first massive problem is the cost. It's astronomical. A typical hedge fund charges what's called a 2 and 20 fee structure. What that means is they take 2% of your total money every single year, plus 20% of any profits you make. That creates this huge hurdle you have to clear just to break even with the market. And on top of all that, their performance data, it's self-reported and unaudited. But the biggest illusion with hedge funds is something called survivorship bias. It's this mental blind spot where we only focus on the winners, the ones who survived, and we completely ignore all the failures. Let me show you how it massively skews the data. Let's say 1,000 new hedge funds get started. Well, research shows that after about 10 years, 3/4 of them have failed. They've just disappeared. Poof. So now we're down to just 250 left standing. And of those survivors, maybe only half have results they're actually proud enough to report. So the official average return that you see in the news, it's based only on these 125 winners. It completely ignores the other 875 funds that went bust or just hid their bad results. It makes the entire industry look way more successful than it actually is. So, after looking at all of these seductive traps, from the crazy Ponzi schemes to these hedge fund illusions, what's the single most important lesson we can pull from all of this? It really comes down to this timeless piece of wisdom from Voltaire. This constant search for the best investment, the secret formula, the 54% return, that is what leads people down these incredibly dangerous paths. A simple, good plan, something like investing in low-cost index funds, is often so much better, mainly because it's something you can actually stick with. And really, that's the question I want to leave you with. In a world that is just full of these seductive promises, are you constantly chasing after the best, or have you built a disciplined, sensible plan that is simply good enough to get you where you need to go? It's definitely something we're thinking about. You ever look at your investment portfolio and think, okay, this is smart, this is sensible, but man, is it boring. Well, today we're digging into that exact feeling and a strategy from our source material that might just let you have your sensible cake and eat the exciting slice too.
Yeah, that's the itch, right? That little voice in your head that whispers, I can beat the market. I can find the next big thing before anyone else does.
I mean, that's the dream that fuels pretty much the entire stock-picking world. But let's be honest, chasing that dream without a rock-solid plan is just a fancy way to gamble. So if any of that sounds familiar, you are in the right place. We're going to walk through a framework that lets you scratch that itch, but, and this is the most important part, without putting your main nest egg at risk. Okay, but before we get to the solution, we have to talk about the biggest problem. And honestly, it's us. It's our own psychology. The number one trap for just about any investor is simple overconfidence. So to make this point, our source material asks a pretty provocative question. Are women better investors than men? Now, studies suggest there might actually be something to it, and it all boils down to behavior. See, when you're overconfident, you tend to trade way too often. You start chasing those flashy high-risk stocks, and that kind of behavior can just torpedo your long-term returns. On the other hand, the patient tortoise approach of trading less and taking fewer risks, well, that's what usually wins the race. And learning to manage that constant urge to act is exactly what this whole strategy is about. So, if overconfidence is the big trap, how in the world do you balance the thrill of the chase with the wisdom of just being cautious? Well, the source offers a really simple, almost elegant solution. And here it is, the 10% solution. The rule is incredibly simple. 90% of your portfolio is the bedrock, right? It's invested in safe, boring, diversified index funds. But that other 10%, that is your playground. That's where you can test your big ideas, chase those wins, and you can do it all without ever risking your retirement. And look, this isn't just a theory. The author's own investment club learned this lesson the hard way. You can see it on the timeline. They started in 1999. They were chasing all the media hype, and you guessed it, they lost money. Then, in 2000, they completely changed course, adopted a disciplined, Buffett-inspired approach. The result? By 2011, they turned things around and were averaging an impressive 8.3% return every single year. So what were those principles? How did they pull off that kind of turnaround? Let's dive right into the playbook they used for that 10% portfolio. I love this quote from the legendary investor Peter Lynch. He said, "Buy a business that any idiot can run, because one day an idiot will be running it." The idea here is simple. You want to invest in simple, durable businesses, not some hyper-complex company that needs a genius at the wheel just to stay afloat. And that leads directly to the first big principle. You have to stay within your circle of competence. All this means is you should only invest in businesses you actually genuinely understand. For example, the Authors Club passed on Apple. Now, it's not because they thought it was a bad company. It's because they couldn't confidently explain its long-term competitive advantage. They admitted it was simply outside their circle. Okay, so you found a simple business you understand. Now what? Well, now you have to figure out if it's a good value. And that means looking right past all the hype and focusing on the cold, hard numbers. A key tool for this is the price-to-earnings ratio, or PE ratio. It's a pretty straightforward concept. It tells you how much you have to pay for every single dollar of a company's annual profit. So, naturally, a lower PE means you're getting more bang for your buck. And this table right here perfectly shows why a stock's sticker price is completely meaningless by itself. Just look at this. The $5 stock has a PE of 25, while the $100 stock has a PE of just 2. So which one's the cheaper investment? It's the $100 stock, and it's not even close. And this plays out in the real world all the time. This data from 2011 from the source shows it clearly. Tech stocks often have these sky-high PE ratios compared to old economy stocks. You know, Bill Gates himself even argued that tech companies should be cheaper because their futures are so unpredictable. But investors frequently pay a huge premium just for the hype. Another critical thing to look for is debt. A company with little to no debt is a survivor. Why? Because when a nasty recession hits, they can weather the storm without being forced to sell off their best assets in a fire sale. Better yet, they can actually go on the offensive during a downturn and buy up their weaker competitors for cheap. Take Fastenal, for example. They're a building supply company. So when the 2008 financial crisis absolutely hammered its industry, you'd expect their stock to get crushed. But look at this chart. Their share price was remarkably stable. What was their secret weapon? It was simple. They had no long-term debt. It gave them a rock-solid foundation. But finding these kinds of gems, well, it isn't easy. You have to be incredibly selective. An analysis mentioned in the source looked at over 2,000 businesses and found that only a tiny 5%, just 5%, were consistently and highly efficient over a whole decade. It just goes to show you how much research and patience this really takes. So once you've done the hard work and found one of these rare companies at a good price, the final piece of the puzzle is all about discipline. You need to know when to just hold on, and you need to have ironclad rules for when to sell. The Authors Club keeps it super simple. They have just 2 rules for selling. Number 1, sell if the company's fundamental business changes. And number 2, sell if the stock becomes just ridiculously, grossly overpriced. That's it. No emotional decisions based on panic or scary news headlines. And that kind of brings us full circle. Let's be really clear about this. Stock picking is a massive challenge, and the odds are stacked against you beating the market long term. And that is why that 90% in index funds is so critical. It is the safety net that lets you experiment and learn with the other 10%. So I'll leave you with a final thought to chew on. What if that 10% portfolio is more than just a playground? What if the discipline, the research, and the long-term thinking it forces you to learn actually makes you a smarter, more patient investor with the 90% that truly builds your wealth? It's a powerful idea to consider.